Beautiful property. Man, I like that thing.
Indeed.
You want to be a good one to add to the portfolio.
You bet.
Hey guys, welcome to Florida. It is a great day here in the Sunshine State. Welcome, John, from the snowy country, Boise, Idaho. Adam, I don't know what kind of weather you have up there in Indiana. I assume it's not too bad.
Doing good.
That's good. We still have the air conditioning on because I think it might have been around 80 today, somewhere like that. So that's the way we like it, though. Anyway, guys, welcome. Thanks for jumping on here. It is great to see many of you. I was just taking a look at some of the names on here. I know a lot of you guys, so thanks so much for stopping by. Great to see some new faces on here as well. So anxious to tell you a little bit about what we've got going on in here in Orlando. We felt like this would be a great opportunity to kind of bring up the Esplanade deal, talk about it a little bit more because a lot has happened over the last couple months since we first brought it up. We've, of course, had a couple of extensions that have taken place. We've had some nice price reductions that have also taken place. So things are heading in the right direction, and we're now looking to bring it home because we want to get this deal done in 22 so that we can capture that 100% bonus depreciation and, of course, get the property going and get it under our management and see the upside there. So excited to get rolling. One thing I will mention is we're planning to keep this a little bit shorter than some of our other webinars. We're going to try to keep it about 30 minutes. We will have a Q&A at the end, so that might go a little bit longer, but we'll try to keep it a little bit shorter for you and just kind of stick to the high points. We're going to talk about some of the current stress testing that we've done on this particular deal, given the market conditions that are out there. I'm actually doing a presentation tomorrow for a mastermind group where I'm going to be going over the economy, the multifamily market, a whole bunch of stuff. It's going to be fun. And then we're actually going to bring that presentation to our monthly Q&A on the 22nd, I believe. John, is that right? 22nd?
That's right.
Yes.
Yep.
So just under 2 weeks away. We're going to bring that to you here. So would love to have you. But I just felt, again, that it would be a good opportunity to present some data. Those of you that have talked with me before, you know I'm pretty data driven, in addition to having a, obviously we've all got a little bit of a gut instinct after 20 plus years in the industry, but it's good to have data. It's always good to be driven by the facts. And if the facts are scary, then either come up with a plan or get some more data or wait. So there's a lot going on right now. Anyway, so we'll jump right into it. I kind of got ahead of myself with the webinar. There's a slide on here for that. But before we get to that, just a brief introduction for, again, those of you who are a little bit newer to REM. So REM is a 8-state, 3,800 plus door multifamily investment company. I founded the company about 4.5 years ago, and we have a simple mission statement, which is the right people and the right deal. And that's really as complicated as it gets. And we try to stick to that in all of the thought process that we use when it comes to finding a deal, managing a deal, is the right people and the right deal. And to be honest with you, at the end of the day, it really comes down to the right people, even more so than the right deal. But of course, you put the two together and you are getting some really nice returns. So that's how we got started. We have seen a tremendous amount of growth over the last 4.5 years. And as you can see on the call here, I've got John, who handles our investor relations. I've got Adam, who is our acquisitions. Trying to think of the right word here.
Guru, expert.
Guru, there we go. The brains behind acquisitions. And then Josh, who couldn't be on the call tonight, he also helps out with our investor relations as well. So the four of us are on the partnership level, and then we've got over 100 people, boots on the ground in our property management, corporate team, implementation team, renovation team, you name it. We like the vertical integration aspect of our business, and we just feel like it gives us better control over the execution of the business plan. Boots on the ground just gives us kind of that span of control that we like. So that's a little bit about us. We are generally pretty conservative in terms of our deal structure and our overall kind of long-term hold strategy, which I'll talk about a little bit later on here. But in general, we like to be a little bit more conservative. We don't like risking our capital. We like to get a good return, but we are a little bit more on the conservative side. So it's been tough to find deals the last few months. It's been a little bit easier. And as I mentioned about Esplanade, this one in Orlando, we've gotten a couple extensions. We've been able to renegotiate the price, which has been appropriate given the market conditions that are out there. And I actually had somebody ask me today, they said, well, what if the price goes down in the next 2 months? What if you walk away and you come back in 2 months, you get a better price? And I said, yeah, that could happen. Could not happen. We don't really know what's going to happen in the market. And so that's something that we're always thinking about. But as I've said from day one, when the market was going crazy on the upside, I said, we're not market timers. I've never tried to be a market timer. I believe in doing good homework, doing your due diligence, and you invest your capital and you make sure that you give yourself an opportunity to get a good return. Now, trying to get lucky, trying to win the lottery, nothing wrong with that. We're always happy to pick up kind of a 10 out of 10, if you will. But, normally in this business, if you just stick to a good, solid regimen of underwriting and due diligence, you're going to do great. And I think Warren Buffett is a great example of that, where, he just kind of plays that steady course. And over the long run, it really provides good results. So anyway, not to belabor the point, but just a little bit of background about us. So you kind of have an idea as we get into this. But we've got a lot of folks on the ground that really help us to make this happen. So with that said, that kind of leads into this next slide, which talks a little bit about our philosophy on risk-based investing. And again, it kind of goes back to the concept of not risking our capital. We'd rather have a good return, 15% return plus 15 plus return, for a very low risk. Try to get it to zero from a capital standpoint. You can go out there and find much higher risk deals. In fact, we have some development deals that are higher risk, much higher return, but they're higher risk. But I think for, call it, the vast majority of the investment dollars, we would recommend being in a safe, stabilized type of a product, similar to Esplanade in Orlando. And the thought process behind that is kind of fivefold. There are kind of these 5 categories, if you will, or 5 components that make up this risk-based investing. First one is stress testing. We'll talk a little bit about that. But basically saying, hey, what if the market gets worse? What if interest rates keep going up? What if I can't refi at the same number that I thought I could? What if occupancy drops? All these different questions that come out as you're looking at a deal. And so we take a lot of time to stress test our deals and make sure that they still cash flow, that they still refinance in a challenging environment. This particular deal, Esplanade, I actually just ran the numbers because I wanted to double check a couple things right before we got on the webinar. And on our financial structure that we've got on this particular deal, we can actually refinance in year 3, which is our plan, at a, let me just make sure I got my numbers right here, 67% loan to value, which is pretty low, at a 7.5% cap rate. Now, for those of you who don't know what a cap rate is, we'll get into that in just a minute, but it's basically a measure of valuation. 7.5 being extremely high, meaning prices have just completely crashed. 67% valuation, 67% loan to value, 7.5% cap rate, 11% interest rate. I don't think anybody's expecting interest rates to be at 11% in 3 years. I think if they are, we've entered the twilight zone. But anyway, and so that would actually cover our refinance in year 3. So you can see the kind of stress testing that I like to do. That gives me the comfort to sleep at night saying, hey, you know what? I do care what happens, but I kind of don't care what happens because this deal is going to cash flow and I'm not going to lose my money. So I thought I would just share that. But anyway, that's an example of stress testing. Identifying risks is another component, number 2 on the list here. There's market risk, cap rate risk, interest rate risk. We'll talk a little bit about that as we get into it, but there's these 3 big risks and you want to mitigate those risks. And so how do you do that? Lower leverage is another component. As I mentioned, how do we make sure that we can cover our debt? Well, simply speaking, lower your leverage so that you know you can make your payment, even if things fall apart. The 4th component is industry expertise. I think that's really important, especially in a market like today, because if you've been through those market cycles, you know what can happen, you know how to handle what can happen, and you also have the resources ahead of time to be prepared. Not everybody in our space is setting aside millions of dollars to protect their investors. I think that's really important. That's how I approach this business. I'm a fiduciary. We are a fiduciary of the investment dollars that we've been given to ensure that we do not risk the capital. Now, it's our money too. So again, it's kind of a important aspect for all of us. The 5th piece is conservative underwriting. Got a couple slides in here that'll talk about that. But again, that's just saying, hey, let's be realistic about our assumptions. Let's not be rose-colored. Now, when it comes to conservative underwriting, that doesn't mean that you are overly pessimistic either. It doesn't mean that you are saying, hey, the world is going to fall apart, et cetera, because again, not investing our dollars doesn't make sense, especially in today's market when the value of our dollars going down by somewhere between 8 and 9%, just sitting there in the bank. Some would argue it's even more than that because of the Fed. But I think it's important to make sure that we also are careful about our investing. So that is our risk-based investing philosophy broken down. And again, if you have any questions as we're going along or thoughts, of course, you can always reach out to us. But there is a question panel. It should be on your screen. So if you have a question, pop it in there. John or Adam will try to answer that. If not, we can always throw it on here on a live answer, and we'll keep going there. So like I said, if you do have a question, drop it in there, and we'll try to get it answered for you.
And real quick, Robert, we did get a lot of questions in the registrations, and thank you for that. And we did include some of those at the end of the presentation as well. So
awesome. Okay, great. Perfect. Yeah, I know we're getting a lot of good ones. So my favorite slide is the disclaimer, which is basically just the SEC language saying that if you are going to invest in this particular opportunity, you have to be accredited. Again, for those of you who may not know that terminology, it just means that you've got to have $1 million of net worth and or 200,000 of income if you're single, 300,000 married filing jointly. So there's kind of some net worth income requirements that go into being able to invest in something like this. We're happy to explain that to you after the call. All right, so let's dig into things here. We've got a couple different components that we're going to look at, from the executive summary, the business plan, location, property details, and then the financials. So start off with the high level stuff on the property story. The gist of all of the deals that we do is that there is upside in 3 different areas. Number 1, management upside. That means that we are looking for properties where the on-site management team is poorly managed, undermanaged, understaffed, doesn't have the right folks in the job, and so the property is therefore not performing as well as it could. Number 1. Number 2, we look for properties that are under market rent, meaning that the property is below what it could be at a market rent if it was properly being managed. So that's almost like the low-hanging fruit, if you will. Come in there, do a better job, pick that rent upside off the table. The third component, and this is where we kind of come into that extra level, is the renovation upside. What that means is that we can come in there, we can take a older building. In this case, this is a 2009 property, which is actually relatively new, but we can take an older building that has not been renovated and we can bring it up to 2022 standards, bring it up to the style that people want in today's market and the style that people will be willing to pay more for. You want a nicer bathroom, you want an upgraded countertop, you want nicer finishes, that kind of thing. People are willing to pay for that in this market. Now, a lot of people would say, well, why not just leave it and just get the market rent upside? Well, that's a great point. And sometimes if we feel like the market is not producing enough results for a renovation, we may do that just to preserve cash flow and to keep our investment going along smoothly. Most of the time, it makes sense because, again, we're in a market where rental rates are rising, partly because of inflation, but more driven by supply and demand. I probably won't have a whole lot of time to talk about the supply and demand issue tonight. Again, that's something that we're going to talk about on our monthly Q&A on the 22nd in a couple weeks. So in this particular property, we've got all 3 of these components. And again, that's the kind of the magic formula for the deals that we like. We want all 3 of these upside components in order to really drive the revenue and drive the profitability of the deal. Now, in addition to that, we're going to look at why these components are in play. So in this case, we've got a property that's in an emerging market that's in the path of progress. What does that mean? Well, you've got an area that was built in 2009. It popped up, kind of fizzled out, and now it's coming back. So the area has been, and this is very true in a lot of different areas around the country. You've got development that comes in. Sometimes it takes 20 years to come back. Sometimes it can take 30 years. But you have development that comes in. It's kind of that first phase. They roll it out, and then it slowly gets infilled. And sometimes as it's getting infilled, you have a different demographic that moves into the market, depending on where it's at, and it can take that market and flatline it, meaning the rents don't really move a whole lot. And then other things happen where all of a sudden now that area becomes more popular. Redevelopment comes back in. The city may say, hey, you know what? This area over here used to be really nice 15 years ago. We need to bring it back. And so that's one of the upsides in this particular area, is that we've got this path of progress. A lot of things are happening. New development is coming in. Infill projects are being built right down the street from Esplanade. And so we're seeing a better resident demographic coming into our area. And so we want to capitalize on that. We want the upside. We want to bring those people down the street, say, hey, you know, you're paying $2,200 a month or $2,400 a month over here. With the rents going up 15% a year, that's really expensive. Why don't you come down the street? We'll give you a really nice finish, a really nice interior. Property looks pretty similar. All right, so you might not get the Olympic size pool and the 40,000 square foot gym, sure, but you're going to save $400, $500, $600 a month. That's a very enticing value proposition for a lot of people, especially right now where we're seeing a lot of inflation. And home ownership has dropped because the interest rates are rising, and so people cannot afford to be homeowners. So we're seeing a lot of demand for this product. We've seen a lot of demand, and it's going to continue. So path of progress, emerging market. I mentioned about the unrenovated interiors. That's something that we really love about this deal. Every single one of these interiors is what we call classic, meaning they have not been touched. So lots of upside. Some deals that you'll see on the market today, they've been renovated once, twice, 3, 4, 5 times. We don't really consider them renovations. When you see something like that looks really nice and it's already been renovated, it's kind of like you're pushing the envelope. So we tend to stay away from those deals because we feel like most of the meat is off the bones, and it may look good on paper, but there's really not as much upside as may be presented. So we really like to look for deals that are 100% classic interior units because that gives us that really nice pop on the renovation upside. From a seller standpoint, in this particular deal, we have a fairly motivated seller. They've owned it for a few years. They were able to make some nice money on it over the last, through the pandemic, and they are looking to make an exit because of one of their partners would like to show a nice return. So, again, it's not a distressed sale, what I would call a distressed sale, but it is a motivated seller. And we found this to be a great opportunity for us to come in. They didn't have a strong in-house management presence. And so they had pretty much said, you know what, we're maxed out. We can't take this any further. We don't have the ability to push it to the level that it could go. And we see that a lot. And again, that's part of the reason we really like having the integrated property management, because it gives us the ability to take opportunities like this and really crank them up. So we've got a motivated seller. And then, like I said, the rent upside is there. The one thing that's not on here that I'd also like to mention is that at this point, we've gone from a initial whisper price that was in the $46 million range. We're now down to 40. Where are we at, Adam? 40 and
41.
change? 41. There you go. So we've, it's taken a little bit of time. Obviously, the market's moved. We've taken advantage of that, and we've lowered the price as the market has adjusted. So again, we feel like we've had the leverage to go back to make sure that we're getting a market rate, even in the current environment, which has been great. We're still keeping our leverage low. So I think we're at a 73% loan to value on our current structure, which is a really nice leverage point at a $5 million decrease in that price point. So again, those are the kind of things that you want to see in an environment like we're seeing today. Now, outside of that, I think part of the property story here is also that we're in Florida. Now, I know a lot of people have said, yeah, Florida, but the rents are so high and people can't afford it. And what's going on? Well, I would make the case that job growth, population growth, industry, business, it's going to continue to flock to places where you're going to have conservative, pro-business environment. So I really believe long-term we're going to continue to see that. I think what we're seeing in Orlando is an acceleration of that because of the remote work environment that's taking over across the entire country. A lot of people are able to work anywhere. And so they're thinking, hey, I love going to Disney. I'm just going to go move to Orlando and I can go to Disney every weekend. I don't have to fly there anymore.
Robert,
So-
that kind of goes into that 1,000 people a week moving into the Orlando MSA, which is pretty amazing statistic.
It's a huge movement, and I think it's going to continue. So anyway, I just want to make that point because, again, I think that's important. We're trying to look for metros that are recession resilient. They're going to do better than the rest of the country. Again, we don't know what's going to happen. I think there's some sort of a recession headed our way, whether it's 6 months or 12 months or 18 or 2, we don't know. But if we're going to invest and we want to invest, because money sitting on the sidelines isn't going to do anybody any good, where are we going to put that investment? Where are we going to put that money? We want to put it in markets where we're going to be most protected and have the greatest opportunity for upside on the other side of this challenging economic environment. So that's kind of the property story. I know that's a lot, but there's a big story here, and that's really what's driving our decision to add this to the portfolio. So I talked about the conservative underwriting and financing when we were going through the risk-based investing, and here's some of the key components. On the financing, it says up to 75% LTV because at the time we were still trying to work out the loan. We're currently at 73%. That's where we've landed. The interest rate, including the float and everything else, is 7.1% today. Now that interest rate is higher than it was when we initially underwrote the deal. So normally you'd think, oh, wait a minute. So doesn't my cash flow go down? Yes, but we've reduced the price to compensate for that increase in the interest rate. Now, what we did on the flip side when we purchased this deal is we're going to buy a rate cap. That means that our interest rate exposure, even if the Fed decides to go crazy and raise interest rates to 11%, we're locked in. We are not going to see the effect of that ridiculous increase. Now, I don't think that's going to happen, but again, this is insurance. This is interest rate insurance that protects us from that exposure. Initially, our kind of our structure, our plan was to put a bridge debt product on this asset and then refinance when we've completed our renovations. And we're still sticking with that strategy. And the reason for that is because we do not want to be locked in today to a long-term interest rate. A lot of people have said, yeah, but isn't that safer? Well, it is, but at the same time, you're then going to be locked into what I believe is going to be a fairly high interest rate. Some people think that 6, 7, 8% is here to stay. They could be right. Again, we've got the protection of being able to refinance at 67% at a 7.5% cap rate with an 11% interest rate. So we don't really need to worry about that. We're going to protect our capital. But I feel like I would like the ability for us to be able to refinance and get out of this higher interest rate loan when I think that the rates will come back down. So that's our business plan, and that's why we feel like this is the correct structure given where we're at in the market today. Now, we want to buy ourselves some time, obviously, because we don't know how long this economic situation is going to go on with the Fed. But I think 3 years is going to give us enough time. So that's kind of our thought process on the conservative financing. On the underwriting side, we've built in a big loss factor in year one because normally we've got delinquency. We're moving people out that don't pay rent or don't meet our qualifications. So we're giving ourselves a lot of room there to ensure that we can still cash flow during year one and not have an issue from a financing standpoint and an underwriting standpoint. The other thing that I think is really important here is that on our actual underwriting, so not the stress test that I mentioned, but our actual underwriting, we assumed a 65% loan to value at, we stress tested it to 52% loan to value at a 9% interest rate. Now, I still think that's unrealistic. I don't think we're going to be at 9% in 3 years, but that was our sort of baseline, 52% loan to value, 9% interest. It's, again, I don't think we're going to be anywhere close to that, but that's our stress test under a normal circumstance. So that's how we call that's why we call it conservative underwriting, because it's kind of taking the scenario that we're in today and really pushing it to the limits to make sure that it still works. All right, so let's talk about some of the high level numbers here. So the purchase price, like Adam mentioned, $41 million. We've got a good chunk of renovation dollars in here for these interiors. Now they're decent interiors. They're not functionally obsolescent, but we want to go in here and really bump them to what I would call an A- quality product. I can tell you we've done this on 2, 3, 4 other deals where we've bought B-class properties in great markets like this, Atlanta, Dallas, Dayton, Ohio, and we've come in and we've put large amounts of CapEx into these B-class deals, brought them up to an A- level, and we've seen 50, 60, 70% growth rates in the rental revenue because of that. So again, this is kind of a proven model for us in a market like Orlando, and that's really the plan here. We've got we've got $840,000 on the exterior. It's still a pretty decent amount of money, mainly some painting, landscaping, that kind of thing. There's some gate work that needs to be done. Some some, parking lots and stuff like that. Oh, there's always things that need to be done on the exterior to spruce it up. So that's the second component. The other big component here is working capital. So we always have 6 months of working capital as part of every single deal. And the idea being, we want to make sure we've got that fudge factor so that we don't have to rely on the lender to reimburse us for every penny when we do a CapEx project. We don't have to rely on the insurance company to reimburse us if the roof gets blown off. We can come out of pocket, we can get that roof rebuilt, and then we can go deal with the insurance company. So things like that really add up when it comes to running a smooth operation and giving us the ability to maximize our investment. And then the last component, of course, is closing cost, which includes our rate cap agreement, legal fees, act fee, all that kind of good stuff that goes into that. So that's our total use of funds. We are putting a little over $14 million in equity, and then we've got about $33 million in debt, which includes that CapEx. So our initial debt is like $29 million with the 14 in equity. So that is what we call our capital stack, or our sources and uses of funds. And that's going to bring us to a return summary here, which is about a 15 to 17% projected internal rate of return, or IRR. That's really what we're targeting on this particular deal, which again, for Orlando, in my opinion, we've been looking at deals for 4 years now. We haven't found anything that came even close to this on our underwriting in the past, and especially not a B-class deal. So that's one of the reasons we're really excited about this, to be able to get a solid return in a great market with a nicer B-class asset. So that's what we're projecting on this particular deal. Again, that's a fairly conservative projection. I would say that if the economy looks pretty bad in 3 years, I think we're going to still hit that number, believe it or not. So my thought is, if the economy only stays bad for a year, we're going to blow it out of the water. If it stays bad for 2 years, we're going to do better. That's kind of how I would rate that projection. So that's our projected IRR. We also have a preferred return of 8%, which we're paying on this particular deal. Now, some people confuse a preferred return with a guaranteed return. Preferred means that the first 8% every single year gets paid to the equity investors. So we don't get paid anything unless that 8% gets paid out. Now, it is cumulative, so that means if 1 year we only do 6%, then we're still going to have to pay that back at some point. But that's our commitment to you as the equity, that the performance of the property has to do at least 8% before we're taking anything off the top for performing, in addition to that. So again, that's just something that we feel like is our commitment there. So that's kind of the structure of the investment term, 5 to 10 years. Again, we're kind of a long-term buy and hold shop. We really believe that's how you reduce risk. And also, when it comes to all the work and effort that it takes to actually build the infrastructure of the team and the renovations and everything else, you kind of do all the work. You want to sit back and get some of that nice cash flow, tax savings, et cetera. So that's something that we look at. That being said, there's no guarantee that it's 5 years, could be less. There's no guarantee that it's 10, it could be more. But I think that's a pretty good range. That's probably 80% of the deals that we do. We sold a couple earlier this year that were 2.5 years for different reasons. We kind of looked at the portfolio and said, hey, 80-20 rule. We're spending 80% of time on these 20% of the deals. We need to get them out of here. Made a great return. One of them, we were 23% IRR. So, that was great. We were able to take those proceeds, do a 1031 exchange into the next deal. So the investors paid no taxes, got a nice bump in their cash on cash return, and it was a win-win. So that's just kind of a little bit of backstory on the investment term. Investment minimum on this deal, very standard for us, $100,000. So nothing earth-shattering there. So that's kind of the high level. Digging into the business plan a little bit more from a time frame, kind of the 0 to 18, 0 to 24 months is what we would call that renovation, repurpose, reposition period, where we're going to go in and upgrade the units, bring on better quality residents, and really, improve that bottom line. Normally, the first 12 months is actually the big push when it comes with residents. We try to compress that into 6, maybe 9 months. But you got to remember, there's a 12-month lease. So it really takes a full 12 months to cycle the entire property, relook at everybody, make sure that they're going to meet our rental qualifications. And then, obviously decide if we want to keep them at that point. So that's kind of the first 12 months. Second 12 months is more just rolling those additional rent bumps. We try to take a measured approach to it too. I will say this, we don't do any mass evictions. That's really not our style. We are going to obviously work our way through the resident, the full resident package and decide, hey, if you're paying your rent and you're okay with taking a rent bump, great, no problem. But we do try to work with people to make sure that it's just not necessarily justifiable, but at least, they see that we're doing things, they understand that we care about them, and they want to stay at the property. We're not trying to just, kick people out and be, the landlords on the front page of the newspaper. But obviously we have a business to run. So it's kind of a good balance between the two. As you guys know, the rent growth across the country has been really strong. It's painful for people, but again, we have to in order to just keep up with the market, from the insurance costs going up, real estate taxes, payroll, and everything's going up. So anyway, so that's kind of the business plan. Sort of breaking down a little bit more into the details of the actual, what I would call the kind of the rent comparables for each of these deals. We look at a pretty broad spectrum of rent comps. And the reason we do that is because we want to understand the range where this property sits. So there's obviously some deals that are what I would call in front of us and then behind us. So the deals behind us or where we're at today are kind of our baseline. The properties that are in front of us is where we're going. We'll probably end up somewhere in the middle at the end of the day, which is why we put all those different properties in there. We come up with an average, and then we use that as a data point to give us a range to say, okay, we're going to end up somewhere in the middle. What does that look like? That's $2.03 a foot. It's about $2,200 for a 2-bedroom. Okay, great, perfect. Now, obviously, we're going out, we're checking that against the current market, and then we're going to take that number and we're going to say, all right, so that's probably where we're at today. Let's assume that we don't increase that rent 1 penny for the next 3 years and build our model around that. And let's see if it works. And that's what we built into the underwriting on this deal. It's what we build into the underwriting on every single one of our deals. So again, taking out some of the, you might call realistic rent growth and just being very almost pessimistic to some degree that we're not going to see any rent growth for the next 3 years. And usually that sounds really crazy. Today, people are like, well, yeah, of course. Yeah, I mean, we're not going to see any rent growth because the market's falling, blah, blah, blah. Well, okay, maybe not. Normally it goes down a point or two and then it comes roaring right back. So we'll see what happens. And again, that kind of goes back to the supply and demand issue, which is really slanted in our favor as investors in multifamily. Mm-hmm. Most of you guys know about the market, Orlando, the reason for investing there. But we thought it might be good to just do a little refresher. John, I don't know if you want to jump in here. I know, you have some good points on the market usually.
Sure. Yeah, absolutely. So, we really love this location. I know that depending on where you're at and where you're going in Orlando, there's a traffic consideration, especially with a growing market like it is. But we found it to be really navigable, and we were downtown in less than 15 minutes, and accessible to the airport, et cetera. So overall, really positioned well, and to the major intersection to the north and the south, there were both really great developments happening, very close to a lot of things that people want to get to. So when we look at a neighborhood, we're looking at big names, Chick-fil-A, Walmart, Starbucks, et cetera, to see, they've done their research too. Where are they putting things? And we really like that. And we have a slide to show that as well.
Yeah, you just reminded me too. A lot of malls around the country are dying or are dead. And the mall that's 5 minutes down the road, Mall of Millennia, it's one of the few malls that it is just booming.
Yeah.
So again, I think that speaks to your point about this area really being a strong area. There's a lot going on. So yeah, that's a great point. So this is another slide here that I think is helpful. John, maybe this is what you're referring to, just
Yes.
the home values around us. Go ahead. I'll let you keep going.
Sure. Well, this is another thing that we always look at too. So with single family home values around an asset that we're considering purchasing, what are they going for in the marketplace, and how is that in lockstep with the price per door of the complex? So, in 186 units, Robert helped me. I think that the quick math is somewhere in the 210,000 a unit.
Yep,
if
exactly.
I recall. So, we love the fact that we're seeing a significant delta between that and the single family market, all the way up to well above $1 million homes in the general area. So,
right. Yeah, I was going to say, our normal multiple is 1.5 times our price per door as kind of a baseline. If we're there, we're good. And in this case, you take your 210, whatever it is, multiply it times 1.5, you're about 315, 320, whatever it is. So that's at the bottom of the house prices around us. So again, great place to be from a replacement, not a replacement cost, sorry, but kind of a replacement cost from, okay, what if I rent, now I want to own. Now, again, as you guys can imagine, in today's market with interest rates going where they are, that affordability factor has been completely destroyed for the single family market. So we think that the multifamily market is fundamentally even stronger than it was 6 months ago because of that. So as a side note.
So
John, you want to go on this?
With the Orlando market, of course, there's the retirement state. Everybody understands that. A lot of people, the snowbirds, all of that kind of conversation. But it's a lot more than that too. What we found out, and Robert, of course, being a resident of Florida, knows. Interesting, the median age of folks is 37 in Orlando, and additionally, number 2 city in the country for job growth. So we really liked a lot of that. And as you see in a future slide coming up, a lot of the jobs that we're experiencing are outside of the tourism industry too, which is really, really strong. So 62% of total percentage of white collar jobs in the county, 2.9% unemployment rate, which that's well below the national average. And that's, again, going back to why we're picking different metros. It's got to have the right job story to be resilient and to be strong in any kind of environment. So we really like that. And Orlando in general, just from the labor force, it's increasing all the time. And it's also predicted to continue to increase, well into 2050. So really strong points there. I mentioned that 80% of Orlando's employment is outside of the hospitality and tourism industry. You've got some really interesting sectors with the job force, 40,000 plus qualified tech workers in Orlando, and number 1 large city where manufacturing is thriving. Forbes mentioned that in 2018, and that has continued today. So some really strong things happening there. Giving you an idea, we mentioned about the median household income. When we get down to roughly 30 to 35,000 for median household income, we start seeing delinquency go up precipitously. So seeing that 55,000 is a really strong number, and that lets us get to that rent multiple for the property where we feel really comfortable. And Robert mentioned the demographic improvement as we continue to turn units. So we see the opportunity there with the comps on rents, the comparable competition in the marketplace, and the median household income also supports that. So property details, Robert.
Awesome. Yes, thank you, sir. Appreciate it. A lot of good info about the Orlando market. We didn't mention the weather, which is actually another huge driver for Orlando. It really is. So property details, I'll go pretty quick here. 2009 built, like I mentioned, it's pretty new property. It's very nice looking property. Nothing, not a lot of deferred maintenance here. We've obviously put some money into the budget to kind of spruce things up. you saw a picture in the beginning on the video of the clubhouse. It looks dated. So we want to put some money into that and really bump it to the next level. But there's nothing that's terrible. You can see by the interiors here. Again, it's kind of that 2008. It's about right. The darker cabinets, the dark countertops. We are actually thinking on some of these that we're going to do a couple different rollouts with our upgrades to where we may not have to completely rip everything out. Sometimes with the correct paint color, interior scheme, you can leave the dark countertops in and actually integrate it into a lighter, brighter paint color, finishes, that kind of thing. Put some backsplash on. So we're going to do a couple things in here to see if we can make it pop and potentially save a couple $1,000 on the interior renovations. But again, we've got about $14,000 per unit if we need it, which is a huge number. I don't think we're going to need all of that, but we'll see how that goes. Actually, you know what? I'm going to go back real quick. This is the picture of the clubhouse. So as you can see, it's a little dated. I mean, it's not bad, but it's dated. So again, there's some upside there to really kind of make it feel like a nice A-class property. This is our breakdown of the renovations. A lot of detail. I'm not going to go over all this, but again, this is kind of the detail that we put together for our CapEx budgets. We do the same thing for the exterior, all the stuff that we've got planned for that exterior budget. And then that breaks down into our 5-year pro forma, which I won't go over in super detail other than to say on the expense side, as I mentioned, there's a lot of pressure on payroll, taxes, and insurance. Those are the big numbers that are getting pushed. Now, Adam, I think you said we got a pretty good number for insurance, if I'm not mistaken.
Yeah, and actually, John, I apologize because I did not relay that to you for this sheet. So we actually have a quote 40% less than what's on our underwriting.
That's awesome. That's what I thought. That's why I wanted to bring it up. Yeah. So that's going to be some nice fudge factor upside, whatever you want to call it. And that's, guys, that's I gotta say, I'm really excited when Adam told me that, because that's in a time where the insurance rates, especially in Florida, are just going through the roof. So a lot of digging to get the right carrier with the right coverage and all that kind of good stuff. So excited about that. From a return on investment standpoint, this is kind of where it all comes together. What does it look like from your perspective? Our expectation is that the first year we're going to be about 4% for the cash on cash distributions, meaning that's the money hitting your bank account on a monthly basis on the 15th of every single month, which will start, let's see, this would be February 15th,
January.
Right?
Yeah. No,
So,
I'm sorry, February. Yeah.
February 15th. That's right, Adam. That's why we keep you in acquisitions.
That's right.
I'm just kidding. So we're expecting that it's about 4% in year one. Now that's baked in with some, upside on the Fed's interest rates. That's baked in with, maybe occupancy gets a little worse than we expect. It's got a lot of that stuff baked in there. So again, we try to be realistic and hit a reasonable number. Our expectation for year two is that it'll be about 6%, year three about 8%. And then after we do our refi, that's when it really gets exciting. And then we're looking at 15+% on the cash on cash return. Now, the one thing I do want to mention that some people lose in this little slide here is that our goal is twofold. Number one, we want to get you as much capital back as possible in that refi so that you can take that money, which is tax-free. Remember, you're not paying any taxes on it, and reinvest it in another project. So what's not on this slide is that reinvestment in another deal and the additional tax savings and cash flow that you're getting at the same time without investing another penny. So that's goal number one. Goal number two is that by the time we get to that 5-year time frame, even if we don't sell the property, we want you to have 100% of your capital back. That's our goal. What that basically means is that you've now taken all of your money back out of the deal. You have no risk, no capital, and yet you still own a nice percentage with the cash flow and the potential upside for that deal. So those are kind of our twofold goals. And again, those are our goals. Those are your goals. That's how we like to operate. We like to be very tax efficient. There is no point in getting a 25% return and giving 8 points back to the IRS. So
well said.
very conscientious about that. I'm going to skip this. A lot of details about the pro forma assumptions. We talked about the preferred return, so I'm not going to get into that. We do accept IRA money. We do accept 1031 exchange money. Now, that's something that I want to stop for a second. If you or someone you know is selling a piece of real estate and they need a place to roll it into, give us a call. Doing a 1031 exchange allows you to take an unlimited amount of capital gain and defer it by reinvesting that money. It's a phenomenal tax savings plan. So whether you've been an active investor and you want to become more passive, whether you've been passive, you want to keep it passive, whatever it may be, this is a really, really phenomenal way to defer your capital gains, your potential capital gains tax bill. So want to talk about that. And then secondly, cost segregation studies. So the ability that the way that we get these tax losses is through what's called a cost segregation study, where we are allowed to break down the components of the building into different class lives, and then certain class lives are able to be depreciated or written off 100%. This 2022 is the last year that we're going to be able to take 100% of that bonus depreciation. It starts to phase out in 23, 24, 25, 26. So last year to do that. So again, you shouldn't make your investment decision solely based on taxes, but I want you to be aware of that because that's going to give us a really nice tax savings. Usually it's about 60 to 70, maybe $80,000 of tax loss per $100,000 invested. So it's a really amazing benefit to owning multifamily real estate. Okay, so here are our questions. So it looks like I could not keep it to 30 minutes. My apology. 52.
Not even close.
Not even close. I tried. There's so much good stuff to talk about. So let's go through some of these questions because they are really good questions. Rent growth assumption, exit rate cap assumption. Okay, so I talked about rent growth assumption a little bit. We are taking the current market rent, flatlining it for 3 years, and then we're putting a 3% growth rate on that rent growth. That's what we built into our underwriting. Now, that is, in general, I would say almost an overly conservative perspective, but it gives us a lot of wiggle room to ensure that we can hit our returns. So that's kind of how we've done it. Now, on the exit cap rate assumptions, we've taken 100 basis point jump from where the market is today for just to start right off. And then we're increasing that 100 basis point increase, 10 basis points per year for our exit cap assumption. So for instance, year 5, we're assuming that we're going to be 1.5 plus or minus about 1.5 higher on the cap rate than we are today. That's a huge jump. Normally in a really bad market, cap rates will expand by 2 points. I mean, that's like everything's fallen apart. So we've tried to model something that is not worst case scenario, but a pretty bad case scenario. Now remember, cap rates are all about timing. If things stay at that cap rate for a long period of time, that's different than if they go down, they come back up. They go down, they come back up. That's what allows us as investors to exit or enter a market or a property based on our knowledge of that market. So we're obviously going to be looking for the opportunity when that cap rate is in a good place to either refinance or sell. And that's part of what we're here to do, is keep our eye on that and make sure that we identify that window so we can maximize your investment. So that's how I would answer that. Property insurance on the assets, I talked about that a little bit. We've actually been able to do pretty good in terms of the cost. However, one of the reasons that we have a challenge with these costs is because we have a lot of coverage and we're picky about our coverage. So we have 12 to 18 months of business interruption insurance, meaning if the entire property emptied out tomorrow, we'd be covered for 12 to 18 months of cash flow. We actually had that happen. I think we had 12 months that we pulled on a policy in Ohio after we had a tornado come through and we had to empty the entire property out. renovate it, rebuild it. And we were obviously glad that we had that business interruption insurance. Believe it or not, that property was empty for almost 18 months, back online in the middle of COVID, and we are actually ahead of schedule on our investor distributions, partly due to good insurance coverage. So that's a big deal. So that's business interruption. We also have property coverage. That's a necessity for the lenders. Now, there's a lot of different property coverage. You can get, dirt cheap property coverage that if the roof blows off, it's not going to cover replacement cost. That's not what we're looking for. Now, are we looking to get the most property coverage so we can rebuild the Taj Mahal? No, but we're in the development space. So we have an idea about what it costs to rebuild an asset. We also have a renovation team. So we kind of have an idea, okay, if something happens and we've got to do a major rebuild, we kind of know what those costs are. We back those costs into a realistic estimate of that insurance coverage. So again, try to be realistic, try to make sure that we're covered. We have a lot of other smaller coverages, excess coverage, liability coverage, renter's insurance coverage. There's some other things, but those are the two big ones. And those are the two that you can really get burned if you're not careful. You also have to be careful about the carrier that you're providing. We just recently closed on a property where Adam could not figure out how in the world the seller was paying so little for their insurance. Well, lo and behold, we found out that insurance carrier filed bankruptcy. So wouldn't you love to be paying a great rate and have $0 on a complete loss claim? Yeah, not a good day. So again, you got to be careful. If it looks too good to be true, probably is.
Cheap rates are us.
Right. Exactly. So that's how I would answer that question on property insurance. Do we always get coverage for loss of rental insurance? Absolutely, we do. That is extremely important because, again, you just don't know. That's a massive number. I mean, if something happens and half the property gets emptied out, that's a massive impact on the financial statement. So, again, we don't have 5 years of coverage, but our 12 to 18 months, the idea behind that is that's a reasonable, if not slightly longer time period than what it would take to rebuild that property. That's kind of the idea behind that time frame. How expensive can insurance against higher interest rates get? What choices do we have? Now, what that's talking about is cap rate, buying a cap rate or interest rate insurance, cap rate insurance, whatever you want to call it. And basically, what that is you are buying an instrument, a financial instrument that is that's protecting your exposure to the rise in interest rates. Now, here's something that's really important to understand. That is it is priced based on expectations of the future. So if we're sitting here today in November 9th, 2022, and everybody's kind of said, you know what, I think the Fed's going to do one, maybe two more hikes, and then they're done. That is actually going to create a much lower cap rate cost than what you saw 3 months ago when everybody said, man, the Fed is about ready to just blow the place up with 4 or 5 rate hikes. So it's all based on expectations. And so right now, we've actually seen that some of those costs are lower than they were a couple of months ago. Now, are they more expensive than they were a year ago when we had no idea about Fed rate hikes? Absolutely. But they were unbelievably cheap back then. In fact, we bought one for $30,000 that, 6 months later was worth like $450,000 because of this change in expectations. So it's all about expectations in the market, and it's a little bit of a tricky game. But again, you have to factor that into the deal and make sure that it works, because it's not worth not having that protection from an interest rate standpoint. Now, what we also like to do is we also like to have working capital reserves in addition to that, so that we kind of have double coverage there, so that we can float some of that upside, but then we're going to pay the insurance for the rest. It's kind of the same idea with property insurance. We'll take a deductible of $100,000. If we got to come out of pocket to do something, no problem. We just don't want to have to pay the $1 million claim. Same concept with insurance against the interest rates. So I think we talked going to the next question here, we talked a pretty good bit about specifically stress testing the deal. So I think I feel like we're pretty good there. Again, Would encourage you guys. Would love to have you on the educational webinar that we're going to do on the 22nd, just about 2 weeks from today. I'm doing that presentation tomorrow for my mastermind group, but I'm going to do it again for everybody here on the investor side. And I think it'll be really educational because I really like to dive into this stuff and, again, really understand the facts. So how can I protect my money during a recession? Well, I have a very simple answer for you. Invest in a cash flowing hard asset, something that is not financial and something that produces cash flow. Now, it doesn't have to be multifamily real estate. It could be some other form of real estate, but that's, if you look at historical trends, you look back, that is where you put your money during a recession. That's how you protect yourself during a recession. Now, again, if you over leverage something, I can't help you. It's not going to work. But if you're smart about it, you stress test it, that's the best place to put your money during a recession. Are we reducing distributions on other deals? We're actually not reducing. We have not reduced any distributions on any deals yet. I only say that because I can't predict the future. We don't anticipate that we will have to. It seems like everything is going to be okay. Every day is a new day with the Fed and the market and the interest rates and inflation and everything else. But we've seen a lot. It appears that inflation has topped out. That doesn't mean the story's over, but it appears that way. I would say if it was still going up and we were seeing 10, 11, 12, 13, yeah, I'd probably be a little bit more concerned. But it appears that inflation has topped out. So we feel pretty good about that. And we have not reduced any distributions on any of our deals. We actually also did not reduce the distributions back in 2020. I had the same conversations with a lot of people asking me, hey, what's going on? The market's falling apart. The economy's just been shut down. What are you guys doing? And I said, business as usual. Distributions are going to roll out. And we never missed a beat. So again, I don't want to predict the future, but we're generally set up pretty well for turmoil. We kind of like to be the antithesis of the stock market. So if you've got whiplash in the stock market, come on over here, get a neck brace, get a little relief. So, all right, perfect. So that was a question. Timeline here, it's changed a couple times, but this is our final. Closing is actually going to be, well, it'll be plus or minus a day or two from December 15th. Our goal is to get all the funds in, obviously, as soon as possible. But that's going to be our closing. First distribution will be February 15th. Again, you have any questions, feel free to reach out to myself, John, Adam. We can always jump on a call or email us. So I will leave it at that. Thanks so much for your time, guys. I really appreciate it. I know that was a little bit longer. I hope it was valuable to you. I hope that answered a lot of your questions. I know there's a lot of concern and fear out there, but we're trying to stay the course and be thoughtful about our investment as we've always done, and hopefully that'll help you out. So thanks very much. Anything to add, guys, before we sign off?
Great turnout. Appreciate the questions as well. Reach out to us if you have any additional questions that you'd like to cover. We have a Calendly link here at the bottom. In addition to that, we have a ready to invest button. It's a call to action. So if you'd like to submit your reservation, please do so. And we'll be taking that on a rolling basis here as we get closer to close. So that's it.
Awesome. Good deal. Thank you, sir. Appreciate it. Guys, we'll see you on the next one. And thanks everybody for joining us. Have a great evening. Until next time, take care. See ya.